If you're married and have $1,200,000 sitting in a traditional IRA, you probably assume your Roth conversion tax rate is somewhere around 12% or 22%. That seems reasonable, but there's one variable most couples never think about, and it could double your spouse's tax rate the moment you're gone. Here's the number that explains it. Right now, as a married couple filing jointly, the 12% federal bracket covers up to $100,800 of taxable income. When one spouse dies, that bracket doesn't adjust. It doesn't phase down gradually. It gets cut exactly in half to $50,400 because your surviving spouse now files as a single person. A $60,000 RMD that sat comfortably inside the 12% bracket as a couple can jump into the 22% bracket overnight. That's roughly $6,000 in extra federal taxes every single year. That's what's called the widow's tax trap. And it doesn't show up in most Roth conversion guides because most guides are written around your current bracket, not your spouse's future bracket. So the real question isn't how much can you convert. It's how much do you need to convert to keep your spouse financially protected after you're gone. That's a completely different calculation. In this video, I'll show you exactly how to find that number, using a straightforward formula I call the spouse protection ratio. If you're married and you have a traditional IRA, this one changes the whole strategy. If that's the kind of content you want more of, hit subscribe. I cover retirement tax strategy every week, and this topic is one I wish more couples would talk about before it's too late. Let's talk about why this happens, because once you see the math, you can't unsee it. In 2026, the federal 12% tax bracket for a married couple filing jointly tops out at $100,800 of taxable income. For a single filer, that same bracket ends at $50,400. Exactly half. That's not a coincidence. It's just how the tax code is structured. The brackets for single filers were not designed to be fair to surviving spouses. They were built around a different assumption entirely. Now add the standard deduction. As a married couple, you deduct $32,200 from your gross income before taxes apply. As a single filer, you get $16,100. Again, exactly half. So the surviving spouse loses both the wider bracket and the larger deduction in the same year the grief hits. Two financial hits at once. Here's what that looks like in real numbers. Say your couple's taxable income is right around $90,000. You're well inside the 12% bracket together. Then one of you passes away. That same household income, which now comes from RMDs, Social Security, maybe a small pension, doesn't shrink by half. The bills don't drop by half, but the tax protection does. Suddenly, that $90,000 of income is being measured against a single filer bracket. A large portion of it spills into the 22% bracket, and your spouse is paying more federal tax just for being alone. And the numbers get worse when RMDs are involved. At age 73, the IRS requires you to withdraw a percentage of your traditional IRA every year, whether you need the money or not. The factor at 73 is 3.77%, about 1 divided by 26, 5, from the IRS Uniform Lifetime Table. On a $2,200,000 IRA, that's an RMD of roughly $82,940 in the first year. For a married couple, that sits comfortably in the 12% bracket. For a single surviving spouse with a standard deduction of only $16,100, the taxable portion of that RMD alone climbs well past the 12% ceiling. Before Social Security is even counted. This is the widow's tax trap. It's not dramatic. It doesn't happen all at once. It just quietly doubles the tax pressure on your spouse during the hardest years of their life. Most Roth conversion strategies are built around your own bracket today. Very few are built around your spouse's bracket after you're gone. Those are two very different problems with very different answers. But the bracket compression is only part of it. There's a second layer that makes it worse, and it involves your Medicare premiums. We'll get there in a moment. So how do you fix this? You need a target, a specific IRA balance that keeps your surviving spouse's RMDs inside the 12% bracket as a single filer. I call it the spouse protection ratio, and the formula is simpler than it sounds. Take the top of the single filer 12% bracket, $50,400 in 2026, and add the single standard deduction of $16,100. That gives you $66,500. That's the maximum amount of taxable income your surviving spouse can have before spilling into the 22% bracket. Now divide that by the RMD rate at age 73, which is 3.77%. The result is $1,764,457. Call it $1,760,000. If your IRA balance at or before age 73 is at or below that number, and your spouse has no other significant income, their RMDs stay inside the 12% bracket. Above that, they start paying more. But most couples also have Social Security, and that changes the target significantly. When Social Security comes in, up to 85% of it becomes taxable income once provisional income crosses a certain threshold. For most retirees in this situation, 85% of Social Security benefits will be taxable. So if your surviving spouse gets $30,000 per year in Social Security, roughly $25,500 of that is taxable. That $25,500 takes up space inside the bracket before the RMD even starts. So the room available for the RMD shrinks to about $41,000, which means the target IRA balance drops to around $1,090,000. Here's a real example. Mark is 66, Linda is 64. They have $2,200,000 in a traditional IRA, no pension, and they're planning to start Social Security at 70. If Mark passes away at 75, and Linda takes her first RMD at 73 with no conversions done, her RMD will be about $82,940. And between that and her Social Security, she will be solidly in the 22% bracket, maybe higher. Federal tax bill, close to $14,000 a year or more. Now run the same scenario with the right amount converted. If Mark and Linda convert down to around $1,100,000 by age 73, Linda's RMD drops to roughly $41,000. With her Social Security, she stays right at the edge of the 12% bracket. Her federal tax bill is closer to $5,500 a year. The difference is about $8,500 per year, and over a 20-year retirement, that adds up to $170,000 in savings, just from converting the right amount. I used to think Roth conversions were purely about your own tax picture. Then I started running these survivor scenarios, and the math told a completely different story. I've talked to people whose surviving spouses were hit with unexpected tax bills they had no preparation for, because no one had modeled the single filer outcome. That's when the goal shifted for me. The real target isn't your bracket, it's your spouse's bracket. So the question you want to ask is not how much can you afford to convert this year. The question is, how much do you need to convert in total, before age 73, to keep your spouse protected? That's the spouse protection ratio at work. Now, there's a catch. If you try to convert too much in a single year, you could trigger Medicare surcharges that eat right into your savings. That's the part most people miss, and we're going to walk through it next. Some couples hear all of this and think, well, hopefully we go together, or close enough together that it won't matter. That's a natural thought, but the actuarial numbers don't support it. According to Social Security Administration life tables, a 65-year-old woman today has roughly a 50% chance of living to age 85 and about a 30% chance of reaching 90. For a 65-year-old man, those numbers are lower, around 40% to 85 and about 20% to 90. And here's what that means in practical terms. When you have two people with different life expectancies, the gap between when the first one dies and when the second one dies can easily be 10, 15, even 20 years. During all of that time, the survivor is filing as a single person. Think about what 15 years of extra federal taxes looks like. If the widow's trap adds $6,000 a year in avoidable taxes, and for larger IRAs it can be much more, that's $90,000 over 15 years. That's not a rounding error. That's real money that could stay in the family. There's also a historical pattern worth noting. After 2008, many retirees saw their IRA balances drop sharply, which temporarily reduced their RMDs, but within a few years, market recoveries pushed balances back up, and RMDs followed. The lesson from that period is that waiting for the right moment to convert almost always means converting under worse conditions. The tax rate environment today, the bracket structure today, and your health today are generally better than what you'll be working with at 73 or 80. Doing nothing is a decision, and over a long retirement, it's often the most expensive one. Let's stress test two real scenarios side by side. One couple who didn't convert and one who did, so you can see exactly where the money goes. Let's bring Mark and Linda back. Mark is 66, Linda is 64. They have $2,200,000 in a traditional IRA. No pension. They plan to claim Social Security at 70. Scenario 1, they don't convert anything. Mark passes away at 75. Linda is now 72 and files as a single person starting that year. At 73, her first RMD hits. On a $2,200,000 IRA, the RMD at 3.77% is $82,940. She also receives $30,000 per year in Social Security. Because her provisional income is well above the IRS threshold, 85% of her Social Security, $25,500, is taxable. Her total gross income is $108,440. After the single standard deduction of $16,100, her taxable income is $92,340. That puts her in the 22% bracket, well past the $50,400 ceiling. Her federal income tax is somewhere around $14,000 per year, and she'll face that bill every year for as long as she lives. Scenario 2. Mark and Linda start converting while Mark is still alive, and they get the IRA down to $1,100,000 before age 73. Linda's RMD on $1,100,000 at 3.77% is about $41,470. Add the $25,500 in taxable Social Security. Total gross income, $66,970. After the $16,100 standard deduction, her taxable income is $50,870. She's right at the edge of the 12% bracket, essentially $5,800 in federal tax instead of $14,000. The annual savings, about $8,200. over 20 years. That's $164,000 in federal taxes saved. Not from exotic planning, just from knowing the right target and converting enough before RMDs begin. The key number is $1,100,000. That's the IRA balance that keeps Linda protected given her Social Security income, not $1,760,000. That's the target if she had no Social Security at all. The Social Security changes the equation. You don't have to hit your number perfectly. Getting close matters. Getting from $2,200,000 to $1,100,000 requires converting $1,100,000 over roughly 7 years, about $157,000 per year. That's aggressive, but it's workable if you start early and stay inside the IRMA thresholds each year. You don't have to convert everything, but you do need a number to aim at. Because without a target, most people just guess, and guessing almost always means converting too little. So how do you actually execute this? 3 steps, and you can work through all 3 with a basic spreadsheet. Step 1. Calculate your survivor's target IRA balance. Use the formula from earlier. Take the top of the single 12% bracket, $50,400 in 2026, and add the single standard deduction of $16,100. That gives you $66,500. If your surviving spouse will receive Social Security, subtract the taxable portion. Assume 85% is taxable. So if Social Security is $30,000 per year, subtract $25,500. Now you have $41,000. Divide that by the RMD factor of 3.77%, and your target IRA balance is roughly $1,090,000. That's the number you're aiming to be at or below before age 73. Step 2. Figure out how much to convert each year. Take your current IRA balance, subtract the target, and divide by the number of years you have before RMDs begin. If you're 66 with a $2,200,000 IRA, you have about 7 years. $2,200,000 minus $1,090,000 is $1,110,000. Divided by 7 years, that's roughly $158,000 per year. That's your annual conversion target. Step 3. Pay the taxes from outside the IRA. This is the most common mistake I see. People take a conversion amount and then use part of that same conversion to pay the taxes. That reduces the money going into the Roth and makes the whole effort less effective. You need a taxable savings account, checking, brokerage, whatever you have, to pay the tax bill separately. The full conversion amount should move intact into the Roth. Now here's where most people run into a wall. If your combined income, conversions plus other income, goes above $218,000 as a married couple in 2026, you cross the first IRMA threshold. That triggers a Medicare surcharge of about $2,297 per couple per year in additional premiums. That can eat a meaningful chunk of your tax savings, so your annual conversion amount needs to account for that ceiling. If $158,000 in conversions would push you over $218,000, you scale back and accept a longer runway. A slower pace is still better than no pace. I remember sitting with a woman who had just lost her husband and found out her first RMD, as a single filer, was going to push her into the 22% bracket. She said she wished they had known about this years earlier. They had time. They just didn't know what to aim for. That conversation is part of why I talk about this. What if your IRA is $3 million or $4 million? Then the math changes significantly. Sometimes converting down to the target is so aggressive that the conversion taxes outweigh the future savings, especially if you're both in good health and don't have a large age gap. In those cases, partial conversion still makes sense, just to a less ambitious target. The point is, know your number, then decide how hard to chase it. Now let's be honest about why most people don't do this, even when they understand the math. Paying $30,000 or $40,000 in taxes today on a conversion that benefits your spouse years from now feels wrong. It feels like a loss. Your brain is wired to avoid immediate pain, even when the alternative is larger pain later. That's not a character flaw. It's just how people are built. I've felt it too. When I first started running conversion numbers for myself, the tax bill stared back at me, and I thought, do I really have to do this right now? The answer was yes, but I understood why it's hard to pull the trigger. Here's a reframe that helped me and that I've shared with others. You're not paying taxes early. You're buying your spouse a tax-free income stream. Think of the conversion taxes as a one-time premium. The benefit is that for every year your spouse lives after you're gone, they draw from a Roth account that never generates a taxable RMD, never pushes them into a higher bracket, and never triggers a Medicare surcharge. The premium is real and it hurts in the short term, but the protection it buys is also real. The widow's trap is most painful for people who had the resources to avoid it and just didn't act. That's the part I want people to walk away from this video understanding. You may have the window. The question is whether you use it. Let's bring it back to the core idea. The widow's tax trap is not complicated. When one spouse dies, the survivor's tax brackets shrink to half, and their RMDs don't. The goal of a Roth conversion strategy, if you're married with a large traditional IRA, should be built around keeping your spouse in the 12% bracket as a single filer. Use the spouse protection ratio to find your target IRA balance. Convert systematically each year. Stay under the IRMA threshold so you don't hand savings back to Medicare in the form of surcharges, and pay the taxes from outside the IRA, not from inside. You don't need to convert everything. You need to convert enough. If you're working through this and want to go deeper on any part of it, the IRMA limits, how Social Security affects the calculation, or what to do if your IRA is very large, I cover all of that in other videos on this channel. Hit subscribe so you don't miss the next one. And if you've already run these numbers for yourself or your spouse, drop a comment below. I'd genuinely like to hear where people are landing with this. It helps me understand what to cover next.